is the forecasts, and this is the median forecast. Out of the 17 Federal Reserve officials, 15 of them do not think that a rate hike up till 2022 will be appropriate. 2 Federal Reserve officials do, though. So I think that with the signal that this sends, really, I think the vast majority think that rates will be on hold, not just for the rest of this year and not just for next year, but even 2022. And what this is telling us, I think, is that liquidity will remain ample. And so with the Fed's announcement, we saw stocks recover in the U.S. and we saw the dollar fall. We really don't know what's going to happen. We still don't know if there's going to be a second wave of the virus. And the body blow to the economy. We haven't had the second quarter GDP yet, but the Atlanta Federal Reserve, which has a model to track the economy, is looking at a contraction of over 50% in Q2. And you look at the Fed's forecasts, what the Fed targets, what the Fed goal is price stability and full employment. And its forecasts tend to be a little bit more optimistic than, say, the OECD's forecast that was released this morning. Mm-hmm. But it still has unemployment nearly 10% at the end of this year. And remember, during the great financial crisis, unemployment reached 10% during the crisis. So I think that what the Federal Reserve is recognizing is that we shouldn't be looking at a V-shaped recovery, that the jobs data on Friday, like you say, last Friday, was a good surprise. But there's still a lot of work that needs to be, we need to have many more months of those kind of numbers to really have a strong sense that the economy has turned around. Stock market's a different story. I think that there's 2 models in our heads about the stock market. One is about fair value based on earnings or macroeconomics, the free cash flow, different models that analysts use. But I think all those models now aren't really the driver. I think the real driver is liquidity. And it's not just the Federal Reserve. Next week, we're going to have the Bank of England likely to cut rates, not cut rates, but extend its asset buying. We're going to have at least 6 emerging market central banks, and 3 of them, including Russia, Brazil, are likely to cut interest rates. And so I think that the shock, we're still absorbing the shock, and there's a lot of uncertainty. And I think that we should expect in the coming weeks China to have lower rates. Several other countries in the Asia-Pacific area, lower interest rates in Brazil and Mexico. So I think that story goes on, and I think that the fiscal story goes on. Next week, at the end of the week, the EU has a summit about its recovery plan, which the EC proposed 750 billion euros. And the other thing that next week about this liquidity story, which is really fascinating, is that the ECB has offered long-term refinancing operations. These are long-term loans. And the package for the loans for next week, as long as banks achieve a certain target of loans that they make themselves, they can take money from the ECB at an amazing minus 100 basis points. This is what I'm talking about liquidity. I'm talking about being able to borrow money from a central bank and get paid 100 basis points to borrow that money. It's the amazing thing about gold right now is it looks like it's behaving like a risk asset. Oftentimes, we think about gold as a safe haven. But right now, gold is rising with the stock market. And so so far we've been in about a $50 range on either side of 1,700. But all this liquidity story that we've been talking about, I can see gold going to 1,800 in the coming weeks, and maybe even as high as $2,000 before it peaks.
Wow.